All right, hi guys. I wanted to welcome you to Realtor Financials. We have Marybeth here, and she's going to take us through taxes, deductions, LLCs, all sorts of fun stuff.
Yep.
So take it away, Marybeth.
Okay. Morning, everyone. Okay, so we're getting towards that time of year, and in my practice, you know, during COVID, I have businesses that thrived and businesses that dived. And I will say anybody involved in real estate thrived this year. The market's been hot. The Treasury came out and said that they don't expect interest rates to go up for another 3 years. So that will increase the market, I think, and continue with refinances and people buying. So my question is, and Susan and her husband happen to be clients of mine. How many of you are LLCs? Raise your hands. Anybody as an LLC? Anybody as incorporated?
I'm thinking about it.
Okay.
We're here.
Okay. So let's just start off with, let's just go through a couple of the president signed it's called the Consolidated Appropriations Act 2021. It was signed December 28th. So throughout this COVID period, the Treasury Department, the IRS, through Congress, have come up with incentives to try to help businesses. There's been a lot of payroll tax credits, deferrals. If you were a business shut down under mandatory government orders, you could get a payroll tax credit if you kept your people employed. Who would that be? That would really be.
Good morning, how are you?
Maybe people in the entertainment.
Are you in the office?
The rule is it has to be
There
done.
is a class right now going on at the Market Center. I'm gonna send you the link. It's through Zoom. It's actually in the office. But
Whoever's talking, can you mute, please?
I'm muting them right now.
Okay. And can I take this off? Is this going to bother anybody on that? I'm far enough away because I can't really speak with it. So the biggest thing that came out of the TAA 2021 was who got PPP loans? 1, 2, 3. Okay. Anybody who's on Zoom over here, did you get PPP loans? No. All right. Loans are forgiven, 100% tax free. So how are you going to get the loan forgiveness if you're all telling me you're not LLCs, which means you're filing your tax return as sole proprietors, is Schedule C, business income expenses. If you got the PPP loan, you had to give that to the bank. You had to show the net income from 2019. And the reason you had to show that is that showed how much was subject to self-employment tax. So the only thing you could get a PPP loan on was wages. If you're self-employed, you don't have a paycheck each week, right? You put the money in your bank account, you take your expenses out at the end of the year, 100,000 minus 50,000, I had $50,000 income. That's subject to self-employment. When I say self-employment, I'm talking the Social Security, the Medicare, and when you're self-employed on a Schedule C, which most of you are here, or in fact 100%, you pay the employers and employees share. It's a big hit. You get a deduction for the employee share, but it hurts. So if you had net income, you were able to apply for a PPP loan. Can I ask for the people that had net income in 2019, why you didn't apply? Was it your banks? Was it, I know you had an issue. The banks weren't good. I'll tell you right now, they were not good in handling self-employed people, which you are, or partnerships. There wasn't a lot of guidance and they really just didn't know how to do it on it, really. Everybody you can go back now and say, well, they could have done this. But if you remember us in March last year, everybody was scurrying around. I mean, everybody was crazy. And then everybody applied for these PPP loans and the banks had to say, we know how to handle this. We don't know how to handle this. So a lot get left out, which is unfortunate for you guys because you really would have qualified. If
did PUA, a lot of I found in this office they either did PUA or PPP. So
What they do for the, what are you talking about in the PUA?
So it was unemployment for self-employed 1099.
Oh, yeah, you could get the additional
But they paid
600.
taxes on that. That was the only difference.
Well, you pay taxes on unemployment all the time. So that's another thing that comes
That's
up.
why I didn't want that.
Yeah, no, unemployment is, if you took unemployment and you took that 600 extra, be prepared on your tax return this year because you will be paying taxes on that. So unless you're withheld, and usually you're not withholding enough, that becomes an issue. But again, the TAA 2021, the good news is if you got the PPP loan, there was a lot of questions. And up to this point in time, when they gave the loan, they said it's not taxable. Well, it wasn't taxable as income, but what the IRS came in a letter in November 2020 letter, they said, well, it's not technically taxable, but if I got $100,000 PPP loan and and that was for $100,000 in payroll. Oh, well, it's not taxable as income, but that 100,000, if it's forgiven, reduces that $100,000 payroll. So in effect, it is taxable. It just increased my bottom line by that amount. If I took 50,000 in PPP loan against $50,000 in wages, and now you're telling me I can't deduct the $50,000 in wages because I used it against the loan, that becomes taxable. My bottom line just went up to 50,000. So everybody went crazy over this. But up to this point, up to December 28th, we were saying to people, listen, this is what right now, what's out there. Until it's clarified by Congress, there's nothing we can do. They clarified it in the TAA 2021. So if you took a PPP loan, it's no longer taxable. Some of the things that if you did not take the PPP loan, and I can pass these out, that you may, although it's real estate, professionals. I have this is just a pass out for, this is some of the business tax provisions that we did for our clients. So of course, we have a lot of corporate clients. Some of these may not be pertinent to you. And we just talked about the PPP loan. But some of them are, this is a good one for you. When you took clients or customers or whatever out to lunch or dinner, that's always been only 50% deductible. So if you spent 100, you only could deduct 50. Because the restaurant industry has been so decimated through COVID, for 2021 and 2022, they're allowing you to deduct 100% of your meals. It's a nice deduction, especially for realtors. But let's talk about, because this is always the question, what is meals and entertainment? To be deductible, it has to have a business purpose. Technically on the receipt, under the law, you have to keep the receipt, you have to put the names of the people you were with and what the business purpose was. If you're trying to get a listing on a house, you take somebody to lunch, you sit there, you say listing, okay? What it doesn't include is I'm stopping by Dunkin' Donuts for a coffee on the way. Or I'm stopping to pick up a sandwich for lunch. That's not included, okay? That's just, even if you weren't working, and that's how you do it. If I wasn't working, would I still be eating? Yes, it's not deductible. But what is deductible is, let's just talk about like this group training. I know there's a lot of realtors that have other realtors under them. They have a pod, they have a group that work with them. They do training with them. They do meetings with them. They bring in pizza, they bring in sandwiches. That has always been 100% deductible, okay? Because if you are providing the food for the convenience of the employee on site so that they work through it, you're giving a presentation, they're eating, then that's not entertainment, okay? That's a business expense, 100%, it always has been. Other things for realtors, and I'm gonna finish some of the deductions and go back because somebody said we wanna know the difference with LLCs, why we should do that and why we shouldn't. Some of the other things, mileage, okay? Keep track of the miles on it. It's worth a lot. I think the deduction actually went down this year, and I'm going to throw out 56 cents a mile, because I think it went down like a half a percent, half a cent on the mileage. So 56 cents a mile. The problem is, as realtors, not a problem. I mean, sometimes you do use, if you use your car for more than 50% business use, and you can document that, then the decision has to be made. Is it better for me to take the mileage, or is it better for me to take the auto, the 100% of the auto, depreciate it, put all my gas in, and go 50% is business? Okay, so let's just talk about that. If I track my mileage in a log from everywhere I'm going, and then multiply times 56%, that's my auto deduction. But if I use my business auto more than 50%, then I have to consider that I just purchased a new vehicle, let's say. Okay, so I get to depreciate it over 5 years. If it's over 6,000 pounds, which is some of these big SUVs, it gets accelerated depreciation, which is kind of nice. I can't, let's just say the vehicle was $50,000, depreciated hypothetically over 5 years, and it came out to $10,000 a year. That's depreciation. That's a $10,000 deduction. I multiply it times the 50%, I get a $5,000 depreciation deduction. Now, yeah.
Is the 5 years the accelerated depreciation or the?
No, the 5 years is the normal depreciation period. Acceleration happens. And so there's all different kinds of rules on luxury auto vehicles, and very complicated on that. But if it's over 6,000 pounds, it goes into a different bucket for depreciation, and more of it can be taken up front.
Yeah.
So instead of like a straight line kind of and that's if it was 50,000, 10,000 each year. If it was over 6,000, I may get a $20,000 deduction up front in the first year. So it accelerates the time period and the amount I can take. But then I've got to look and go, okay, what is going to work out better for me? Because 56 cents a mile is pretty good if you're deducting. Now, what does the 56 include? If you're taking mileage, that's your repairs, that's your gas, that's your insurance, that's your car wash, that's everything that goes along with the vehicle. If I can itemize it down, because I use it more than 50% for business and I can prove that, then I can take all of those expenses, accumulate them, all the gas, and go, okay, 50% of all of those expenses I'm going to take. So I'm itemizing it more than taking the standard mileage. But you have to be careful with that. There's different laws on it. But I know for real estate, I mean, what's the asset you use most? Your vehicle. There's no question about it. The only problem you're going to have is you'll have, I don't think it's quite as what it used to be. It used to be you would pick people up at the office, right? And you'd go see 5 houses in a day or something. Now with cell phones, everybody goes, I'll just meet you there.
Insurance doesn't like that.
No, I know. They don't like when they're in the car.
Yeah.
So, so the question is, when does my business mileage start? Do all of you have offices in, this is your headquarters,
Here
right?
and home.
I'm home. I have a
And-
home
and
office.
You have to decide, you can't have both.
yes.
Okay, so there's where you run into a problem on, do I have a true home office? Okay, home offices, I do a lot of administrative, I meet clients in it, which you guys really don't. So I would say the office here versus the office home, that becomes a question. I think it's probably an individual question for all of you on how much, you use each office. And that's something you should discuss with your tax preparer, because that is important. You could take the home office because you are filing on your individual tax returns. But again, I don't want to go down that road because there is a lot of technicality against it. And I think because I have some realtors that never go in the office. Okay, they actually just kind of work at home. They go in once a month. But if you have a physical presence here and you have a dedicated space, then you have an issue with that. All right. So realtors, we just went through, and we can say that if you have a home office and you qualify, and I'm not going to go into the qualifications, then you should be tracking all your utilities, all your landscaping, all your, all your insurance, all of this. Because if my house was 5,000 square feet and I had 1,000 square feet, obviously this is a big house and I'm exaggerating this, 1,000 square feet dedicated to my office, has to be a dedicated space. I can't be in the corner with a desk like this, a TV on, and the kids' toys and everything around. It has to be a dedicated space on this. What you can do is in that situation, 5,000 square feet, 1,000 dedicated to my office, 20%, right? I could take 20% of my household expenses and apply those towards my home office.
Can I use HOA fees?
Yes.
Oh, no, because you have a dedicated office here that you take.
Well, you can't, you may not. I mean, I don't,
I mean, that pays for landscaping and whatever.
I know, well, if you could take the home deduction.
Yeah.
If you could take a home office deduction and you qualified under the law, HOA fees would be just like mortgage interest and real estate taxes are all part of it. Now, you can't double dip. If I take in this situation, 20% of all my household expenses, I can also take 20% of my mortgage interest, 20% of my real estate taxes. But when I move over to Schedule A and I'm itemizing, I can't use that same 20% again. There's no double dipping. Okay, mortgage interest, if it's $10,000, $2,000 is going towards the business home office. The remaining $8,000 is going as an itemized deduction, no double dipping. Okay, so you just have to keep that in mind. So from real estate, I would say, those are the two big things, right? Travel. And some of you do your own advertising, right? So you have an advertising that you do. What else? What are some of the other expenses?
Administration.
Yeah, administration. I hire somebody to do some work for me. And that's a good point because you asked the question when we came in. I hire somebody to do work for me. If I pay them over $600 in 1 year, I have to issue them a 1099. Make sure they know this up front. There's a lot of people that get surprised. Well, I thought I was doing this under the table. Well, not if I'm writing a check to you, because if you don't declare them on a 1099, then you really can't deduct them against your income. Okay, it's a gift. You just made a gift to them. You didn't make a business deduction. All right, no doing that. No double dipping. You're gonna hear that a lot, not double dipping. So 1099s are due January 31st. If you need to get the information, whenever you hire somebody, before you hire them, there's a form called a W-9. You go right on the IRS website and pull it out. It's called the W-9. You make them fill it out. Name, address, social security number. Store it away. You need that to do a 1099 at the end of the year. So that is if you hire them as an outside employee. If you're going to hire an outside contractor, if you're going to start having employees, then you're going to have to get payroll system and a payroll company in. And I do know some realtors that do that, actually. So for realtors, I mean, administrative, marketing, auto, T&E, or meals and entertainment, travel and entertainment, coaching again, that's an expense. How about if I travel to a convention?
Yeah.
Okay, travel to a convention.
How about realtor dues?
Realtor dues are deductible. Education, yep, that's another one.
Cost of sales.
Yep.
When you go to a convention,
Mm-hmm.
can you include everything the entire time you're at that convention in that space while you're there?
Yeah, but if you're going to Disney, you can't put Disney tickets while you're there. Okay?
Coming
No,
forward.
it has to be, yeah, it has to be, yeah, you could do that, but you don't deduct it. And you can't go and say, I'm leaving on a Friday to go to a convention that's Saturday and Sunday in Florida. And I'm going to extend it for 5 days and go to Disney Monday through Friday. anything you incurred during that time in the convention. But also, since it's outside of the 2-day period, if you do that, technically, the fare coming back is not deductible because it's personal. Because you flipped over and made it personal. So there's lots of rules on that, but that just kind of gives you, you got to watch out for that.
If you had a business meeting on the last day,
You might be able to get around it.
it's find the Keller Williams
Yeah.
office.
Yeah.
Yeah.
closest to Disney.
Yeah.
There you go.
Or you make sure every day you visit a Keller Williams office down in Florida
There's a lot.
and say hello.
Or look at investment property.
Yeah. Or look at investment properties for a customer, right, a client. So there's ways to get around it. I'm not saying, people do it different things, different ways. Your CPA, I'm not your auditor. I'm not going to sit there and start drilling down on all of this. I usually, with my clients, we have a conversation. I make them aware of what the rules are. But you're signing the tax return. I'm signing as the preparer, but you'll also sign an engagement letter that says it's prepared based on what you gave us. All right, I'm not liable if you start, you want to deduct it all, go ahead. But when it comes back, we'll help you out for a fee. But you've got the responsibility for the tax return. So the other thing with realtors, so I asked the question right up front, is anybody an LLC? Or are you just all sole proprietors? The reason most people, so what to understand is when you incorporate, when you register your business, because it's not an incorporation, LLCs are recognized at the state level. Up to about 15 years ago, not all states had an LLC. So when I go to the Secretary of State, so the first thing if I want to start my business, what is the first thing I have to do? I have to go to the Secretary of State's website and I have to register my business. I have to identify what I do. I have to give a registered agent who is somebody that is responsible for the paperwork. And I have to identify who's the manager of it. So I go in and I register my business and I can register as a corporation, an LLC, a partnership. So most realtors or a lot of people, because they come in all the time, they register as an LLC because everybody says you should be an LLC. What does an LLC stand for? Right. So what it does is it gives you protection under the law that if somebody sues you somehow for some reason, who knows what, but people can find lots of ways to sue. Before they can sue you, they have to sue the LLC. And only after they go through the courts and sue the LLC can they try to pursue to the owner of the LLC. But usually that LLC is enough to stop them, okay? Because you can't get blood out of a stone. If I, only have $20,000 in my bank account or 10,000, if that, for my LLC, I have no other assets. I don't own a building. I don't own anything. Well, good luck. Here's the 10,000 you can sue me for. But they can't go after my $500,000 home. All right. So a lot of people do that for the liability protection under the law. When I do an LLC, now there's a couple of things I have to decide. If I want to remain a sole proprietor, as most of you are, then I'm fine. I can continue as an LLC under my social security number, which is what most of you do. If I don't really want that, because honestly, I don't like that I always, when I'm doing things, I have to give my social security number out. I'm just not happy with it. It's kind of like everything about me is floating out there. So what people do is they apply for a federal identification number under the LLC. So now instead of having my social security number, I have a federal ID number. The cost, it's $500 a year in the state of Massachusetts for registering an LLC. So you gotta every year you're responsible for that. It's like $500 for an LLC, and then you have to file an annual report, and I think that's $50. So you do have some compliance requirements once you do that. It is, more expensive. It's $500 you're not spending. Is it deductible? Yes, it's a deductible business expense. you know, so some people choose it, some don't. But once I choose an LLC, that doesn't mean I'm a sole proprietor. I can go to the IRS and say, oh, you know what? I decided to go into business with this other realtor. We're going to form this business organization. So I don't want my LLC to be a sole proprietor anymore. So, and let me just back up. Under the IRS code, an LLC that is a single owner, meaning if each one of you filed your own LLC, defaults to a Schedule C on your tax return, business income and expenses. Single owner, that's the default. But I can change that. I can go to the IRS and I can file an entity classification and say, I don't want to be taxed that way. I want to be taxed as an S corporation. Or I'm bringing somebody in and, you know, this other realtor and he or she is going to be a partner of mine. So I don't want it. I want my LLC now to be taxed as a partnership. We can do an entity classification. We change that. All right. So that's basically how it works. I won't go into, there's some reasons why people do S corps and all of this, but I don't think it's really pertinent to you. So I'm not going to go down on that.
Why wouldn't you just do an S corp if that's how you want to?
Because an S corp, one of the requirements is, why would you do an S corp? So let's just go through the difference. When I gave that first example, if I had $100,000 in income, I had $50,000 in expenses, I had net income of 50. That goes on when you do your individual tax return, that 50,000 is your business profit and 100% of that is subject to Social Security and Medicare, employer and employee. So the employee share of Medicare and Social Security is 7.65%. Double that because I'm also the employer. So just round it around. $50,000, 15%, $3,000, right? Is that right? 10%, yeah. No, $1,500 would be subject to Social Security and Medicare right off the bottom line, right? So let me just do the numbers because I'm wrong there. 7,500.
7,500, yeah.
So I'm like really too low, that's low. So right on that 50,000, 7,500 you're paying in employment taxes. And you're going to get a deduction for half of that, okay, the employee share, but it's certainly not quite the same. Why people choose S corporations. If I was a realtor that made $500,000 net, let's say one of these ones, what happens is, do I want that whole $500,000 subject to employment taxes on a flow through, you know, and a Schedule C on your individual taxes? Kind of adds up. Even though you hit the Social Security limits, you don't pay over that, you still have this Medicare tax, which is about 3%. Okay. So a lot of people, because of those tax structure with payroll taxes, an LLC, which is taxed as a sole proprietor versus an S corp. An S corp, the flow through earnings are not subject to employment taxes. But the rule is, if you set up an S corp, and we do hundreds of S corps, you have to take payroll, which means right now you just wait, you draw out of your bank account when you need money at the end of the year. The accountant goes, you know, abracadabra, you give them all the information, bang, this is your $50,000 net income. In an S corporation, you can't do that. The requirement is you have to take payroll out of it. And why? Because they don't want that 50,000 that when you were a sole proprietor under an LLC and you had to pay Social Security taxes on it, they're not going to say just because you changed your structure, you're not going to pay any Social Security, because if you didn't take payroll, that same 50,000 would flow through from an S corp, and the flow through from an S corp is not subject to payroll taxes. So everybody is kind of, you always kind of balance it out and go, okay, you know, what's best for me? Payroll services cost money, you know? So sometimes you have to look at that and say, is it really worth it? But you can certainly, any one of you could absolutely set up an S corp, and the rule for the wages is it has to compensate you fairly for the work you do. So if I'm doing $100,000 in business, and when I was a sole proprietor, I had net 50, I can't set up an S corporation under the same scenario and say, oh, that's okay. I'm only going to take $10,000 in payroll and I'll let the 40 flow through, not subject to payroll taxes.
Bonuses.
They're not going to do it. Yeah, you can't do that. Okay, so it's always a balance on, you know, what compensates you for the type of work you do. And, you know, there's other advantages. One of the things I think all of you should be taking advantage of is SEP IRAs. So unlike a traditional IRA, when you have earnings from self-employment, which you all do, you know, it flows through, that earning you can do what they call a SEP IRA. And there's a calculation to it, but I'm going to tell you, you can usually fund up to about 20% of your net income. So if I had $50,000 in flow through income, back again to the Schedule C, 100,000 gross minus expenses, I have 50,000 net. That 50,000 net that I'm paying in my taxes on, I can hit 20% of that and put it in a SEP IRA. And I get the deduction for it. So instead of now, let's say, so 20% would be $10,000. I can put $10,000 in a tax deferred, like IRA. What's the difference? Self-employed plan, self-employed pension IRA. That's what it is. That's the only difference. You can fund more than a traditional IRA. And you can put a big chunk of money away, not pay the taxes on it. So instead of paying taxes on 50,000, employment taxes, everything, I'm only paying on 40.
So the employment taxes get deferred too?
No.
Because I just heard that.
No.
You said-
No, the employment taxes actually don't, but that's what I said. There's this weird calculation that has to go on. So if you look at the rule, the IRA, it says, it says 25%, but by the time you do these recalculations and everything, it ends up being 20%. So yeah, it's just like if you do a 401k, if anybody's been employed and they had a 401k, it reduces your federal taxes, but it doesn't reduce your taxes that are subject to payroll taxes. It's the same thing. But it's still a nice chunk of change to put away, and it's a great way to defer. So I happen to do SEP IRAs, even though I am an S corporation. I can do them also in an S corporation. The one thing when you do SEP IRAs is you have to include all your employees, and the rules they have to have been employed for 3 years. That's the one thing. So they do kind of give you a little leeway there. But from the first dollar after 3 years they earn, if I take a 20% SEP for myself, I have to do a 20% SEP for all my employees, for my company to take the deduction. I can't discriminate in it. All right, so these anti-discrimination rules.
You said employees though.
My employees,
W2.
Yeah,
W-2, my W-2, but I'm an S corp. Okay, I'm not a
You're
flow through.
automatically in that though.
Yeah, I'm already in a W-2, but I still, off of my net income in my company, I can fund to SEPs out of my profit, but I have to include all my employees, which is fine. You know what, it's kind of, we work as a bonus. I give employees bonus on it. They're happy. Some of them would prefer to have the cash, but I want the deduction. And, no, I mean, and so what I say to them is I happen to have one employee in a little different situation. And I said to him, here's the thing with, because, his family, but didn't have a lot of savings. I go, the one thing about when you put money away like that, if I was to withdraw it out early, it would be subject to income tax and a 10% penalty. There's certain ways to get around the 10% penalty. I had a medical issue. There's other issues. So if I'm like under 55 and I start drawing, I'm going to get penalties and I'm going to be subject to income tax on it. But as I said to him, here's the thing. If the worst, thing happens, the sky falls, the worst thing, of course, who would have thought anything worse than COVID could happen? But, the worst happens, you're unemployed, you have no money, take it out of there. Who cares? Pay the 10% penalty. You're in a 0% tax bracket anyways. So you're not gonna be paying income tax on it. You're just gonna pay the penalty on it at 10%. Who cares at this point? So I always like to say to people, don't think of it, it's kind of like a forced savings plan out there. If the worst happens, you know what? I can take it out and I'll take the 10% penalty. That will be nothing compared to me because I'm probably in a zero tax bracket. So what's the most I'm going to pay on that money? If it's, I take 10,000 out, $1,000, and Massachusetts. But, it's a good way. Reduce your taxable income in current years when your income is high, and then you can defer it out. So, be surprised how much those accounts grow. And that's something that's available. There's lots of different pension plans and different ways of doing it. But at your level, I would say the SEP IRA, you also are entitled to do a simple IRA. But let's just go back to a SEP IRA because people go, well, how do I do that? You call up Vanguard, although based on your experience, that wasn't good. You call up Vanguard, you call up Fidelity. It's already too late. You would have had to do it by the end of December 31st for this year. So if you didn't do that, consider a simple, funding a simple, again, a deduction on your tax return, but you call them up and you say, I want to set up a SEP IRA. And they give you all the paperwork and walk you through it.
It's actually all online. It's
Yeah.
really easy.
Yeah, and you just can fund it each year. So I recommend you do something like that. Let's see, other issues for real estate professionals. I think that the most difficult time is how many people have spouses that also earn income? Yeah. The tough part is when you have to make estimated taxes, you all should be making quarterly estimated taxes. How do you make estimated taxes? The only way we can do it is based on your prior year, which is why when the IRS funded that PPP loan, they did it off of your 2019 taxes. If you applied, you had to give them the Schedule C with everything. So, your CPA, your accountant should be helping you with the estimated taxes. But, if you hire a firm, a CPA, and this is what people get wrong, you have to agree with them on, what are we doing for you? If you're hiring me just to do your tax return, I'm going to do your tax return. I'm going to calculate out the estimates, and I'm going to calculate them out on what only thing I have is the income from the year I'm working on, unless you say to me, my income's going to go up $100,000 or $50,000 this year because of this. I have a big sale that went through. I know these things are happening. Other than that, I don't know that information. So I'm going to give you estimates, but that's not a guarantee that by the time the next year rolls around and you do your taxes, that those estimates are covering. If I did estimates on $50,000 of net income, which we keep talking about, that 100 minus 50,000 taxable to you. If I'm doing estimates on 50,000 and you come into me the next year and it's 100,000, your net income, you're going to have a tax situation. So if that's happening, you need to call your CPA, and it's going to be, I will tell you, it's a different engagement because it's an engagement to do tax projections now. Okay. You're going to call them and say, I think I'm going to have a problem and I'm going to owe taxes and I don't want to owe because I'm going to be subject to underpayment penalty and interest. And if you make over 110,000 and this is combined with your spouses, you go into a situation, they call it a safe harbor. You have to have paid 110% in of your prior year's liability not to be subject to penalties and interest. So if you get your tax return done and you owe $30,000 or $20,000 with it, there's a good chance you're going to get penalties and interest on that. If it went up and you didn't anticipate and make the payments. Now, when would that not happen? And it happens a lot. Let's just do 2019, I had $50,000 in taxable income. And so I made all my estimates on 50,000. My accountant said, oh, you know what? Let's do 110%. So instead of paying 50,000 in, I'm gonna pay 55,000. That's the estimates. Because the accountant is going, we're gonna make sure you meet the safe harbor. So when you look at the estimates and I go, they're so high. Well, your income was high last year. I'm multiplying the liability times 110%. Yes, you're paying 10% minimum more. Why do we do that? Because now next year, if it goes up to 100,000 and you come in, I can say, well, here's the good news and the bad news. The good news is you're not going to be subject to underpayment penalties and interest because we met the safe harbor. When I gave you the estimates for last year, I made you pay in 110% of your of that liability in this year. So the good news is you're not going to owe penalties and interest. The bad news is you're under withheld and you owe a tax bill.
Did I get safe harbor?
No. So, you know, what happens is, you know, you are going to owe on the liability and you're going to have a check ready at that point in time. So there's all different ways and it really depends on who's you're working with. If you're trying to do it on your own, you know, I know there's tax programs and I mean, if I tell you some of the stories. So here's one of my favorite is, and I'm just going to preface this with my tax program costs $12,000 a year. Okay. My software just for my tax program is $12,000 a year. It's not $69.99. Okay. At Staples. So I'll get these calls, which are always, I had a couple of funny ones. So the call is, I've always done my own tax return. I do it in TurboTax. So, but I want you to just look at it. I go, well, you know, that's not, we either do your tax return or we don't. I'm not here to teach you tax law and I'm not here to review your work. That's not what we do. So if you're going to do it on your own, do it on your own. Don't call a CPA and say, will you look? I'll send you the TurboTax file. I don't want to see it. Not interested. Then then I'll have you do the tax return, but I'll send the file. No, I don't want the file. I want your original tax documents. I need to look at the information. I'm not going to audit what you did. Does this equal what he did? You just added another whole level in it. We don't do it. No CPA does it. So don't make those phone calls because they just don't do it. If you want to do TurboTax, go ahead. You know, I'm sure in some ways, you know, a lot of people can kind of do that. But if you're self-employed and you have all these other issues, I would say I would be hesitant on that. My other favorite call that came in, it's kind of unrelated, but everybody, you know, all the big buzz is going on about the $600, ooh, you know, I get another check if my income and all of this. So when the first stimulus went out, we were flooded with, how come I'm not getting it? Well, because you made $250,000. Okay, it's not entitled. That's not who the intent was. Let's talk about what the intent was. So now the second round comes. And by now the people that called know, you know, you didn't get it the first, you're not getting the second. But I get a call and I get a call from this woman. This just happened the other day. And she says, I'm calling for my in-laws who are expats. What is an expat? An expat is a US citizen living in a foreign country. The rule is if I'm still maintaining my US citizenship, I get taxed in the US on worldwide income. Doesn't matter where I live, okay? Now, the foreign country, if I have to report there, will usually give me a credit. So there's always a credit that goes back. You don't get double taxed by United States and another country. There's a tax treaty usually, and there's a credit for taxes paid to others against it. So this woman calls for her in-laws who now live in Hong Kong. I go, okay. She said, do you do expat returns? We happen to do expats. Certainly not every firm does them. They're more complicated under the law. And there's a lot of liability. There's $10,000 penalty right away for underreporting and expats. So as you can see, it's not an easy thing to do and it's not without risk. So I start this conversation with her and I said, okay, well, give me a little information about them. Well, they haven't filed since 2009. I go, okay. And she said, I said, so I'm thinking to myself, why do they want to file now? But I'm not asking it. So I started asking questions. I said, well, when they went to Hong Kong, by the way. When they went to Hong Kong, in 2009, did they sell a house? And then I said to her, oh, never mind, because it's de minimis. The law was 500,000. You can exclude up to $500,000 of a gain on a sale, which you all know that married filing joint, right? On that. And I said, so I made a joke and I said, unless they had a house in Silicon Valley, that's not going to happen. She says to me, just so happens they did. I go, okay. So now they moved to Hong Kong, don't file a tax return, sell a house in Silicon Valley, and probably didn't report all the gain on it.
And they want $600.
And well, so we get down and she says to me, and I almost fell on my chair. I go, okay. I said, she goes, we really want to file this year. And I said, really? I said, because you have to be prepared as soon as we file. They should have been filing and it's going to open it up. Well, they really want the $600.
People are so stupid.
I'm not kidding you. True story.
Yeah, we deal with
And-
that level of stupidity.
Yeah, and I said to her, really? I said, well, here's the thing. It's going to cost you $1,500 minimum for us to do the tax return. So, I'll get back to you,
Yeah.
which I knew, it wouldn't. But that's just an example of how this stimulus crazy has made people on it. My mother is 97 years old. She's in a nursing home. Her mother lived to be 100. So, I mean, I don't know. I don't think I really want to live that long. Please forgive me. So anyways, my mother survived COVID, 97 years old, 90 in the nursing home, survived it last March. Unfortunately, I had 9 in the nursing home, 8 years younger, who did not. So anyways, my mother now, does everybody understand? We're probably getting a little off track, but if you have assets and you have to go into a nursing home,
Yeah.
right? You have a parent, right? What happens? If you haven't set up an irrevocable trust, like if you haven't put their house in a trust, 5 years, and they're talking about moving that to 10 years. What's going to happen if my father was alive, my mother and father owned the house jointly? Let's say they had $100,000 in the bank. The first thing they do is they say, out of that 150 is hers, so you need to self-pay, use up your assets. And as soon as she goes after that 50,000, they use up that 50,000, she can apply for Mass Health. And Mass Health picks up the nursing home charges. But since the asset of the home is still in her name, what they do is, and let's say the home was worth 300,000. They split it down. They would never kick my father out, but they will put a lien on that house for $150,000, her 50% share. So the nursing home, the Mass Health goes, yeah, we'll pay the nursing home for you, but we pay them 10,000. We increase the lien on your house 10,000, pay them another 1,000. The lien is now 20,000, 30,000, up to 150,000. When my father would sell that house, there would be just like a mortgage lien. Yeah, they would have to pay that off. That's why you hear people, talking about moving their parents' house into an irrevocable trust. We happen to be lucky. My sister is an estate attorney and we did that. So my mother's estate was preserved for that. But my mother, she gets a pension, my father's pension, she gets a small Social Security. The state takes that right towards her care, but we still have to file a tax return. But it's a pain in the neck because she's under Mass Health and now we've used her assets up, everything that wasn't in a trust. I file a tax return. There's no taxable income, right? Because it's the nursing care. She gets the $1,200 stimulus check. She's 97 years old. So it goes to my sister who handles my mother's affairs, who's an attorney, and she's like, I want to give it back. I don't want it. And I go, I know why she doesn't. And my other siblings, I'm one of 9 children, are going, what do you mean give it back? Put it towards, her mercy meal, because my mother is old Irish. So my last name's Massimino, but I'm actually Rourke, my maiden name. So like we're all Irish. And if anybody knows, like, do you remember when your parents would come back from funerals? And my mother would always say, we would die, the kids would, they looked great. I'm like, how can they look great? But that was always very important to her generation. Like funerals were a big deal. Like it was a social event you went to, you know? And so my mother in her own mind, you know, wrote out her own obituary, told us what dress she wants to be, you know, don't ever give that dress away. That's what I want to be buried in, you know, so she's of that old thing. But the whole point is we couldn't give the $1,200 back. But if you take that kind of money and you have a person, a relative, and you're the handling their affairs, you have to refile with Mass Health because you have to declare income, every income. So my sister, who's the estate attorney, is like, do you know that $1,200 is going to cost me $5,000 in legal fees? You can't, well, we're sitting on it right now, but they'll reissue and get in touch with you, but we don't want it. So now she's like, I don't want the 600 either. And I'm like, that's up to you. I can't do anything more about it.
Can I ask a question?
Sure.
So my daughter didn't get one. My son did, her fiance did, she didn't. I was told that and she's in, like, she needs it.
When she files her
When she files her
2020 tax
okay,
return.
That's
Yeah.
what they said. So when they file their tax return, do they have to ask for it? or
No,
what
so
happens?
when you file your tax return, and we haven't seen the new schema for it, there will be a section that says a refundable
Okay,
credit
cool.
on that. So if she didn't get it, and that will be one of the questions we ask, then we can fill out that and try to get it for her on that. Go ahead.
I have a question about you know how in case you're behind in filing your quarterlies or whatever, can you like catch up now before you file?
Well, so if you're behind on your estimates, you can file at any point in time. And
I mean, can you pay it?
yes, no,
Well,
you
we
can
have
pay
till
it.
January 15th.
January 15th, but the sooner you get it in, the better, because the penalties and interest start accruing from the date you made the payment. So there is, what I recommend is the IRS website, www.eftps.gov, eftps.gov. You can go in there and register an account, all right? You can also do it on Massachusetts Mass Connect. It's called Mass Connect. Register yourself, because then you can make, instead of having to get a coupon, write a coupon out. We give the coupons, but we give them as references. And we tell people, write down when you made it, EFT and all of this. You can do it right online. You link it up to your bank account, wherever you want the payments taken out. Every time you want to make a payment, you can go in. So, you know, usually there's 4-quarter estimates, but that doesn't mean I can't make 10 payments during the year. If you're a person like, I can't wait for a quarter, I'll spend the money, then you know what? You go in, you register online, Mass Connect, EFTPS, and at the end of the month, you look at your income minus expenses and you come up with, you know, I'm going to put 25% to the IRS and 5% to Massachusetts, and you make those payments off of that money right away on it. And then, you know what, it's not in there.
So if you have, like, we pay quarterly, my husband's also self-employed, so
Mhm.
we both pay quarterly. So let's say for a June payment, we knew that we were not having a great quarter, so we make a lower payment then. And then the September payment, we make it up. We're not gonna get a penalty, correct? Because we-
So the way the IRS looks at that is they look at your income, and let's say you and your husband, it's 100,000. Unless you're CPA or whoever's doing your tax return, you tell them the IRS considers that income earned evenly throughout the year. So if it was not, there's another form, because there's tons of forms, it's called annualizing. So in that case, I have to go in and recalculate out and show the IRS, out of that 100,000, only 10,000 was in the first and second quarter, 90,000 was in the third and fourth quarter. And then they'll apply the estimates towards that and say, are you underpayment or not? But it's another form, and you have to tell people on that because you will be subject. Whenever I see penalties, like when we're doing tax returns, again, on my $12,000 software, I just had to pay the bill. So it's really like driving me crazy that it was that expensive. Yeah, I know, it's, well, you know, your husband's in the same business. Our software costs are a fortune. So, but it's on my mind. What happens is if I'm doing a tax return, I'm reviewing, I mostly just review. If I see somebody with a penalty and it's kind of significant, then I'm going to make a phone call back to them and say, listen, when did this income come in? Because right now, maybe I can get this penalty down for you, because I'll try to annualize it and I'll try to move the income into different quarters so that when they recalculate it out, it doesn't happen. So there is a way to get around that, but watch that. So if you see a penalty on your tax return and you're using a CPA or another firm, you need to go back to them and say, you know what, my income was earned equally over the year, you know, this much in this quarter. And you need to show them exactly, divide it up on quarters.
We have one question from someone on Zoom. Frank is asking, if one only had income from investments, dividend, and interest, but no earned income, is that income subject to the minimum tax requirement?
The minimum, what minimum tax? It's subject to income tax.
So I don't know, Frank.
Frank, I'm trying to understand the question. Can you unmute him?
Yeah, this is Frank. In other words, I had no W-2 income this year.
Okay.
It only came from, investments that I had, and that also included some IRA withdrawals.
Yeah.
So I know I have to pay the tax on it, but obviously I didn't make any estimated tax, quarterly estimates, so it's going to be one big tax liability. Is that subject to any minimum tax requirements?
Yes.
Yes.
It doesn't matter what your source of income is. Income
Okay.
is income.
So I'm going to likely pay a penalty.
You will likely pay a penalty, but you said I took IRA distributions. When did you take those?
Last couple of months.
Okay, so right away, I just was talking about annualizing. You have
Okay.
whoever's doing your tax return or you're doing it, most likely the chunk of your income is going to be those IRA distributions. So you want to do the annualization and show
Okay.
that most of your income came in the last quarter.
Okay, and the other thing is that the 2020 income is substantially less than my 2019 income.
So you won't be subject to penalties in that case, but you'll be subject to late payment interest.
Okay. Okay.
All right. The penalty is for underpayment of the withholdings. And that's based on the safe harbor of 110%. But if you're underpaid, you're underpaid. You'll be, if you don't, but if you file before April 15 or whatever, I don't know if they're going to extend, you will not get the interest. It's only if you try to extend it.
No. I mean, I'm going to pay it. I don't expect to, well, like I said, the payment was substantially less than it was in 2019.
Yeah. So let me just think, and you didn't withhold on that, but you're under the safe harbor. You've met the safe harbor, but you're going to be late if you make it by 1/15 and that the big chunk of that came in the fourth quarter, then you should be okay. So you should try to make your estimate by January 15th.
Just an estimate. So I just send them a check.
Yeah, just make an estimate, send them a check or go online where I said EFTPS, register and just make that payment and that should cover you. You shouldn't actually have any penalties.
So there's no Medicare or Social Security on that kind of income?
No.
Okay.
That's passive income. Yep.
Okay.
Can I ask a question going back to PPP?
Yeah.
If it's fully forgivable, but when you are a sole proprietor, we just take money out as a draw.
Mm-hmm.
And obviously that money was supposed to be used on payroll. So how do you account for this? Because then when I do the accounting as a draw, it's not reducing my.
Well, so the way you're accounting or how it's going to be done, when you received the PPP loan, right? It was based on you providing your 2019 tax return. So it was, let's go hypothetically back. In 2019, you showed 50,000, you got a $50,000 PPP loan. Now, how is that going to be forgivable if I'm self-employed? You're going to do your 2020 tax return. And when the Schedule C comes down, if that's 50,000, the same as it was in 2019, it's going to be forgiven 100%.
And if it's more?
If if your income was 60,000, then what's going to happen is I get to take the payroll, plus I get to take rent, plus I get to take some utilities and software costs. They actually expanded the law to include that. So even though you had 60,000, you're going to have to do a calculation. And so if I took a $50,000 PPP loan and I have 50,000 this year, it wipes it out. If I took a $50,000 PPP loan and I only have 40,000 on my Schedule C this year, without taking these other expenses, right? If I took 50 and I only should have 40 in income this year, I'm going to have to repay $10,000 back.
If you have less income this year?
Yes, because it was based on 2019 where you had 50,
Yeah.
okay?
Got it.
So if I only had 40
So
in
now you're
taxable
comparing
income,
it to this year, and you're
exactly.
dragging it out before you really know.
Well, you have to, the banks haven't come for it either because they know the tax returns aren't done, right?
What
So
if
you
your
have
income significantly different, like between 19 and 20,
higher or lower.
like significantly higher?
Well, at significantly higher, you've covered it,
Okay,
right?
okay.
That's
Oh,
why,
You're talking about 20, I thought you said 20.
no, in 2019, I have $50,000 in income. In 2020, I have taxable income of 100,000. I covered that 50,000, 100% is
Oh,
forgivable,
okay, I gotcha.
okay?
Oh,
The
okay,
problem is
see.
I took 50,000 in 2019 was on my tax return. I filed my 2020 tax return and I only show 40,000. I took a $50,000 loan advance. It's an advance,
Yeah.
okay? And I only used 40,000 towards payroll. Right now I have $10,000 that's
Yeah,
gonna
but
have
you're
to.
not doing payroll or so.
No, it doesn't. Yes, you are. You do. Your net income is all subject to payroll. So that's the difference between what Frank said. Frank was talking about his investments. That's passive income, investment income. Anything subject to wages, subject to payroll taxes is referred to as earned income. Okay, so $50,000, I got the loan advance based on my 2019 tax return, earned income. 2020, I filed my tax return and that in earned income is only 40. I have a $10,000 gap. What can I use that $10,000 gap? And in the handout I gave you, if you look under the PPP loan, they expanded what could use. They said you can use rent, utilities, mortgage interest when applying for the loan forgiveness. You could always use that. But what they added was software, cloud computing, other human resources, and accounting needs. So last year's tax CPA's bill, I don't know, $1,000 bill, according to this, $50,000 PPP loan, earned income of only 40 in 2020, I'm $10,000 short. Where am I going to find that $10,000 so I don't have to pay it back? I'm going to look to the accounting bill I paid last year. I'm going to look to some of my software costs. I'm sure you guys pay software costs with Keller Williams. You may have some online software and all of this. I'm going to look towards those. The tricky part here is if I can qualify as a home office, see how it says rent, utilities, and mortgage interest? If I'm qualifying, and that I'm not going to tell you who qualifies as I have a home office, then if we use that example where my home office was 20%, I might be able to take 20% of the mortgage interest and apply that towards my $10,000 shortage because that's associated with my home office.
Another question. So what if it is less, but it's still above, self-employed were capped at 100,000 per year? And then you could get,
It's not capped.
Yeah, they did.
the income was capped. And
Yeah,
then
they
you
capped
could-
Well, you're talking for the PPP
Yeah,
loan,
Then
yes.
you could get 2.5 months worth of
Yeah.
100,000.
Mhm. It's still the same thing. It was capped at $100,000 per employee or per self-employed.
So then if you were still above the cap, then it shouldn't be a problem.
No.
For the forgiveness.
No, yeah,
Okay.
If
No,
you
so-
pay for rent here, like if you paid rent for
Here?
an office here, then we would never be able to use our home office.
that's correct. But you might be able to use, if you're paying rent, towards that 50 versus 40 shortage on the
Right.
PPP loan.
The rent here, yeah.
So, I mean, that's something. All right, listen, I gotta wrap it up because my office is
Can I make one
crazy.
comment? So my husband is a CPA and he's not a tax accountant at all, which is why we hired her. So she works in the same office as my husband, but her own business. So didn't the first couple of years really, truly, my husband tried to do our taxes and we now have to file an amended return, which Marybeth will be doing because my husband's a doofus.
Mhm.
So, I mean, he's a very smart accountant, but he is not, if you're not a tax person, don't touch.
It's not something you're working all the time,
No,
yeah.
you really,
yeah.
you can screw yourself so badly and you don't even know it.
Mhm.
So, and this is from, I'm an accountant too. I'm not a CPA, but that's my degree and I would never touch this. So, anyway.
Any other questions from
Can I
people?
ask one more
Sure.
question? I wrote something down, but I might not have got it right. Like you said, you have to issue a 1099 if you hire someone as an employee, but what if you hire?
I know, as an outside contractor, yeah. Yeah, no, if you hire him as an employee, you gotta go through a payroll service
But
and do
what
a,
if you just did like a
1099.
bonus job and you're a contractor?
if they're over $600, you have to issue a 1099,
If you want to take a deduction.
if you want to take the deduction. Otherwise, it's a gift.
Can we take a deduction on the gift?
No. Gifts are not deductible. That's another question I get.
Well,
I'm gonna give 20,000 to my kids. Can I deduct it? No.
but real estate gifts are to our clients.
Yeah, oh, yes,
So,
yes.
and there's another little trick that I just learned, and she can corroborate if this is true. If you put, like, if someone makes something for you and you put your logo on it, it's now marketing. It's not a gift, so you can deduct more of it, just saying.
Well,
Because
you
there
can
was
deduct
a-
the cost of it, whatever, putting the logo on, logo development and whatever.
So,
So if you get a PPP loan for $10,000, can you claim that $10,000 as an income for your next year, for your?
No, you don't want to. No,
you
it's
don't
not.
want
It's
to,
PPP loans that are forgiven are excluded from income.
which is
Oh, okay,
wonderful.
it doesn't, not,
It's not taxable income to you, no.
okay.
No, that changed with the TAA 2021 signed in.
Thank goodness.
Yeah, I know. Well, it was a big issue for us. I mean, I had people that took 2.5 million, 3 million, big companies, you know? I mean, that's, and they're hurting. And to take that to the bottom line when you're not producing is a lot. So, yeah. Well, I hope this helped you.
If it's okay with you, I'm gonna send out all of your information.
Sure.
And I'm gonna scan that in as well, but that way people can reach out to you.
Yep.
So everyone will get every.
Perfect.
She's kind of mean if you don't do it. She won't know.
I can be tough.
She's perfect for me. I love it.
All right, guys, any questions from people online? We're all set? Okay.
Thank you. Thank you.
You're very welcome.
So I have an estimated, do I have what I need for my payment to you guys?
Let's do your tax file, yeah.
So,
The income go up.